Hello, welcome to Truth Behind the Showcases, your global fashion retail and supply chain podcast. Today, Monday, June 1st. Freight rates just hit a new upswing with June surcharges already announced. Vietnam has quietly overtaken Bangladesh as the world's second largest apparel exporter. Luxury brands just posted their weakest quarter in years while sportswear surged. Plus, EU-China trade tensions are escalating fast. I'm Sedat Sezer, breaking down the news and insights you need to start your day. Let's get started. We're back, 1 week off for the holiday, and the world didn't wait. Let me start with something that lands directly in your inbox this morning. Freight rates just enter a new upswing. The Shanghai to Rotterdam rate hit $2,773 per container as of May 21st. That's up 28% in a single week, and up 37% year over year. Shanghai to Genoa is even sharper, up 44% of the year. Now sitting at $4,082, and the big carriers aren't done. CMA CGM has already announced that June 1st surcharges. Rotterdam at $4,700, Genoa at $5,500. These are not projections, these are price lists that take effect today. And it's not just ocean. Air cargo costs have jumped 40% since the US-Iran war started, now averaging $3.43 per kilogram. The Drewry Index clear. Middle East geopolitical pressure and fuel cost uncertainty are not short-term noise. They are a sustained upward floor. If you are moving goods from Asia to Europe or the US this summer, the cost picture you built into your Q3 and Q2 model may already be wrong. The math shifted while we were on holiday, which connects directly to a broader sourcing map question that's been developing for months, and it just got a lot more visible. Let me take you to the Southeast Asia. A sourcing shift that's been quietly underway for several years just crossed a threshold you can't ignore. Vietnam overtook Bangladesh as the world's second largest apparel export in 2025 last year. Vietnam's total textile and apparel exports reached $39.64 billion. Bangladesh came in $38.82 billion. The gap is narrow, but the direction is clear. The structural reasons behind it are durable. Vietnam's advantages are well documented, but worth restarting precisely. A broader product portfolio, stronger logistic infrastructure, more bilateral trade agreements in place. And on raw material sourcing, fabric from China arrives in Vietnam in roughly 1 week. In Bangladesh, the same sourcing cycle can take up to a month. The gap in responsiveness is not a small operation detail, it's a competitive mode. Now Bangladesh's position is more complicated than the headline suggests. The country still has enormous capacity, and brands aren't walking away, but the loss of LDC preferential status is coming. And when it does, the tariff shield that has underwritten Bangladesh prices competitiveness in the EU and UK market disappears. For sourcing directors reviewing their 2027-28 allocations, that conversation is already happening. If you ask me, the real question isn't which country wins this race. It's whether buyers start diversifying within Asia more deliberately, or whether the freight cost surge we just discussed actually makes the nearshore math look stronger than it has in years. Which connects directly to the retail demand picture, and it's split right down in the middle. Start with the luxury. In Q1 this year, 4 out of 6 major luxury fashion groups reported declining sales. LVMH posted total revenue of €19.1 billion, down 6% on a reported basis. Fashion and leather, the core of the group, contracted 2% organically. Kering came in at €3.57 billion, down 6% for the quarter. Gucci alone fell 14%. Even Hermes, which has been the most resilient name in the luxury for the better part of 3 years, saw revenue edge down slightly from €4.13 billion to €4.08 billion on currency headwinds. The exceptions were Prada, up 14%, and Moncler, up 12% in constant currency. And that gap inside luxury is the real story, not the aggregate decline. The winners are the brands with sharp creative identity and tight distribution. The ones being squeezed are the brands that expanded too fast and are now competing on breadth rather than the desire. For anyone supplying premium materials into this tier, leather goods, specialty women's, high-end accessories components, the procurement conversation has shifted. When your consumer's flagship brand is down double-digit, the discussion is no longer about the new categories. It's about protecting margin, and that pressure always flows downstream. Now flip to sportswear, because the contrast is stark. Adidas delivered Q1 revenue for 6.59 billion euros, up 14%, with net profit at 484 million euros. ASICS grew sales 29.7%. Amer Sports, that's Arc'teryx, Salomon, Wilson, posted a 32% revenue gain to $1.945 billion. Technical apparel alone was up to 33%. And all of this before a signal ball has been kicked at the FIFA World Cup, which kicks off this month. The World Cup demand window is real and it's short. Jersey, training gear, footwear, branded accessories. The production pipeline for this event was locked in months ago, but the retail sell-through effect runs June through July. If you are in performance fabrics or licensed sportswear production, this is your peak window for the next 2 years. Same pattern, different market. Consumers under pressure don't stop spending. They trade down in some categories and stay loyal, or even trade up in the ones that matter to them. Performance and sport clearly still matter. Now let's go to China, because there are two simultaneous signals this week that point in opposite direction, and you need both of them. First, the manufacturing side. China's official manufacturing PMI dropped from 50.3 in April to exactly 50.0 in May, the lowest reading in 3 months, right at the line between expansion and contraction. The Middle East conflict is compressing global demand and pushing input costs higher. China's industrial engine, which powered strongly through Q1, is now visibly slowing. For anyone with a China-heavy supply base, this isn't a panic territory, this is a watching moment. When Chinese factories are operating at or below full capacity, lead time responsiveness tends to improve and spot pricing often softens. That's a short-term lever for buyers. The medium-term question is whether a sustained PMI softness signals reduce investment in capacity, which eventually tightens supply. Now the second signal, and it's indirect tension with the first. China's luxury shoppers are coming back. The stock market rally has created a wealth effect, and it's showing up in purchasing data. Louis Vuitton and Burberry reported growth in their Chinese stores in Q1 for the first time in several quarters. Coach is accelerating. On Alibaba's Tmall and Taobao platforms, premium brand sales above 200 yuan threshold grew 39% in the January to April period, while lower price brands actually softened slightly. I've been watching this industry for over 25 years, and here's what split tells you. Chinese consumers are not in retreat from premium consumption. They are being more selective. The brands with clear identity and genuine desirability are capturing the rebound. The ones that rode the wave without building it are still struggling. For global brands deciding how much to invest in China's retail presence right now, this is the most nuanced signal you'll see all months. Which connects directly to the last major story today, and it's one with longer legs than almost anything else we've covered. The EU-China trade relationship is heading into a new phase of friction, and it's moving fast. The European Commission has formally stated that the current trade and investment relationship with China is unsustainable. Brussels is preparing new protective measures targeting strategic sectors. Eurostat data puts the EU's 2025 trade deficit with China at 359.8 billion euros, imports at 559.4 billion euros, exports at almost 200 billion euros. That's not a rounding error, that's a structural imbalance that European policymakers are no longer willing to absorb quietly. Beijing's response was direct, a warning that discriminatory measures against China companies will be met with countermeasures. Both sides are heading into June G7 and EU Leaders Summit with this on the table. Now here's what this means for sourcing strategy. The EU is moving toward deliberate de-risking, not decoupling, but reducing dependency in targeted areas. Every time that policy tightens, sourcing teams start looking for where else they can place volume that meets EU market requirements without the political exposure. The Mediterranean corridor, Turkey, Morocco, Egypt, Portugal, gets more interesting every time this conversation escalates. The practical read, if you are a sourcing director with a meaningful EU market exposure, the risk calculus on China concentration is shifting. Not because quality or price is changing, but because policy risk is repricing. Be ready for that call. And one more signal before we close, because it cuts across everything we've discussed today. Ross Stores in the US just posted Q1 revenue of 6 billion euros, up 21% total. With comparable store sales up 17%, EPS came at $2.02, nearly 40% higher than the year-ago period, and well above the company's own guidance. They've raised their full-year outlook. This is a discount retailer, off-price, value-driven, and they are absolutely running. The CEO pointed to increased customer traffic and tax refund-driven spending as key drivers. Read this alongside the luxury Q1 weakness, and it tells you something clean and important. The consumer hasn't left the building. They've renegotiated their terms. The apparel and retail demand that luxury is losing isn't evaporating. It's migrating to channels that feel justified in an inflationary environment. For fashion brands and their suppliers, the question is where you sit on that spectrum. The main question I want to leave you today is, with freight costs surged, the EU-China trade relationships recalibrating, the consumer splitting sharply between value and premium, which part of your sourcing and market positioning is genuinely resilient, and which part was built for a world quietly changed while we were away. That's all for today's analysis. To make sure you never miss the insights behind the numbers, hit subscribe wherever you get your podcast. I'm Sedat Sezer. Thanks for tuning in. I'll see you tomorrow, and until then, stay ahead of the curve.